Everyone wants safe investments, but the real value unlocks when you combine this safety and stability with growth. Hi everyone, I am Anjal and today we are going to discuss one of our PMS fund strategies, that is dividend yield fund. We have with us Karan Arora who handles product at Green Portfolio to discuss everything related to this strategy. Hi Karan, could you walk us through this fund?
Hi, Anjal. So the dividend yield strategy works like a small cap fund by giving you high levels of capital appreciation along with the bonus component in the form of stable income arising out of dividend yield. This fund invests majority of its capital in the small and mid cap space along with some capital for large caps and REITs from time to time.
Okay, this allocation mix looks very interesting because there's a perception that only large cap stocks and blue chip stocks tend to give a good dividend yield. Why small and mid cap space?
So that's a good question, actually. Um, Dividend yield funds in our country are investing majority of the capital in the large and mega cap space, and they're able to achieve a dividend yield of about 2 to 4%. Here we feel there's a compromise being made. So what we are doing is that we're taking majority of the capital, about up to 80%, and investing it into small and mid cap space, and the rest goes into large caps and REITs. What we're able to do by this is we're able to achieve a dividend yield in the range of 3%, plus the CAGR of our funds come to in the range of 30%. Right. These are companies that are able to grow at a 25% plus CAGR, as well as have enough free cash available at hand, despite wherever they wanted to invest for capex to distribute as dividends. Right. In this manner, instead of having cash on the balance sheet, they're able to increase or maximize their ROE as well by distributing in dividends.
So, Karan, I feel numbers make it much easier to understand these things better. If you could give us two examples, that would also explain why Green Portfolio as a fund is better than all the other funds that are into dividend yield stocks.
Yeah, sure. To simplify it mathematically, let's take an example of two funds. Fund A, where 80 to 90% of the allocation is into giant and large caps. CAGR of this fund will be in the range of 15%, and the dividend yield that we'll be able to achieve would be around 2 to 3%. Then there's us with a multi cap strategy, which is investing 70 or 80%, up to 80% of its capital in the small and mid cap space, is able to achieve a dividend yield of about 3%. But here's the caveat: the CAGR of this fund is in the range of 30%. Now, let's assume your investment amount is 50 lakhs in each fund, which is also the minimum ticket size. Let's break up the returns from both the strategies into a CAGR return plus bonus component, which is the dividend yield. Strategy 1 or strategy A will pay you 9 lakhs in total, 7.5 lakhs being from the returns of capital appreciation, and the 1.5 lakh being dividend yield. Strategy 2, which is us, will pay you 16.5 lakhs in total, 15 lakhs being returns of capital appreciation, and 1.5 lakhs being dividend yield. Not only this, the 1.5 lakhs here will be reinvested, earning similar returns next year, explaining the compounding effect.
Okay, thank you, Karan. These examples that you just gave make it much easier for me to understand. Green Portfolio Dividend Yield Fund not only delivers moderate yield growth but also delivers impressive capital appreciation, which is very difficult in small and mid cap space because one, they are very aggressive, and second, they are very volatile. So, how do you, as a fund, scout these type of opportunities?
So that's what makes us stand out of the crowd, right? We have an in house research team of CAs and CFAs who not only do factory visits from time to time, but also meet up with the management of the companies. We firmly believe that the management or the quality of the management can really make or break the company. Gauging their vision by meeting them personally helps us understand how firmly they believe in their own companies.
Karan, when we invest in large cap companies, specifically for dividend, we know the risk is lower. But at the same time, when we combine this portfolio of large cap companies with small and mid cap space, it comes with its own risk and return characteristics, right? So, how do you mitigate this risk?
So, managing risk or mitigating risk is going to be a top priority, especially in a strategy where we are required to preserve capital plus deliver a stable kind of a growth, right? So, there are two things to this. Firstly, we are well diversified across sectors in the portfolio. Secondly, we are staggering our entry and exit approach, which means that we are dividing our capital into multiple tranches in order to avoid market timing risk. Another thing that there is that these companies that we are going to choose for this portfolio are always going to be companies that have a strong promoter group parentage. These are large groups which have a lot of free cash generating ability by default due to the sheer size and scale, which also brings us comfort in knowing that this company or group has the ability to give back cash, right? So that's another thing.
Karan, coming to the most important question, what type of investor would benefit from this strategy?
So this fund is mostly suitable for investors with a moderately aggressive risk appetite. People who are looking for a long-term growth, but also some kind of a stable income aspect in their portfolio. This portfolio is specifically for those. Also, what people should look at this as is, if you already have very aggressive allocations in your overall equity portfolio, having a small allocation to this as a supplement is great, because then you are hiving off the risk from that aggressive allocation and also adding a stable income component.
So when we invest in other type of asset classes, be it mutual funds, be it AIFs, we often have entry and exit loads. Do you have something like this in this portfolio?
No, so we do not believe in exit loads. There is the expectation from a client that have a long-term horizon for this fund. Like all funds, if you're investing in the small and mid-cap space, you need to have a 3-year plus horizon. But other than that, there are no exit loads in place.
And can NRIs invest in this fund?
Absolutely.
Coming to the last question, how do you as a fund ensure that my money is safe with you?
So that's the beauty of SEBI regulated products. SEBI has made these regulations which make an investor's life much easier. What they have done is that they have introduced the concept of custodians. So in India, there are 12 total SEBI registered custodians whose job is to hold custody of PMS funds in India. What they do is, these are the entities that are regulated by SEBI and are responsible for keeping your money safe, right? The money that you invest through a PMS never goes to that PMS, right? As a fund manager, our responsibility is to instruct brokers on what trades to take in what quantities and at what times in your portfolio particularly, right? When it comes to green portfolio, we have tied up with 3 of the 12 custodians. We have Novama, we have ICICI and Orbis as options for our clients.
Thank you, Karan. I hope we have answered almost all the questions of investors. Thank you for joining us today.
Thanks. Thank you so much.